The Commission's problem with this ruling is summarized quite neatly by the Advocate General, where he says the Commission concluded that a number of choices concerning the methodology and parameters and a number of adjustments approved by the Grand Duchy of Luxembourg and underlying the transfer pricing analysis and the tax-related issue resulted in a reduction of the corporate income tax, right? And this is where this 30 million comes from that Margrethe Vestager is referring to. First, in relation to the capital remunerated, the Commission did not consider the tax advisor's chosen profit level indicator, namely FTT's hypothetical regulatory capital, to be appropriate in applying with the TNMM, because they said you should use the real capital. The Commission thus found that by using the hypothetical regulatory capital of 28.5 million instead of the accounting equity, which was 287 million, the tax advisor has divided FTT's taxable remuneration by 10. Second, as regards the application of the Basel II framework in order to determine the hypothetical regulatory capital, the Commission considered that the Duchy of Luxembourg had made errors that led to FFT's hypothetical regulatory capital being underestimated. In other words, it never should have been those 28 million. It should have been much, much higher. Third, the Commission found that the FFT's tax advisor made several deductions from its remaining capital that departed from a market-based outcome. In particular, the tax advisor's decision to isolate the equity component designated as equity supporting financial investments was inappropriate. So whatever capital you put into subsidiaries, that was not appropriate. And I think the argument here would be something along the lines that if you need that capital as a bank, you would invest it in something, and that investment would not necessarily generate a tax-free participation income. Fourth, the Commission considered that a tax advisor's choice of a beta of 0.29 when using the cap method determined to the return on capital was not in line with the arm's length principle. And then the CAPM here is the capital asset pricing method that they used together with TNMM to calculate the taxable income. And then the Advocate General summarized the Commission's point of view in the last chapter and in the last paragraph, and then in a couple of paragraphs later he talked about what the General Court thought of the Commission's argument. Remember, the Commission won, right? So before the General Court, so the Advocate General reminds us, it says, as to the plea based on errors in the method of calculation used to determining FFT's remuneration, the General Court held that in the decision at issue, the Commissioner had correctly found first that FFT's capital should have been taken into account in its entirety for the purpose of calculating the remuneration for its intergroup financing and treasury activities. So the General Court agreed on the first point, right, and the second. Second, that the Grand Duchy of Luxembourg should not have used the hypothetical regulatory capital of FFT as a base for calculating risk-free remuneration. Third, that Luxembourg had wrongly excluded part of FFT's capital equal to its shareholding in its subsidiaries from the capital to be taken into consideration for determining FFT's remuneration for its intergroup financing and treasury. The General Court consequently held that the methodology approved by Luxembourg tax authorities had minimized FFT's remuneration. So this is how FFT calculated its taxable income, and how the Commission said this was wrong and how it should have been done. And the General Court agreed with the Commission that this is the way it should have been done. There is something that is bothering me about this case, and it's the following. If we look at the structure here, right, we've got Luxembourg borrowing and lending to the US maybe, and to Italy, and then to Canada, and then back to Italy. There's no real tax haven involved here. So the question is, why was the Commission unhappy with this case, and where did the savings go, right? Now, one possibility is that the income in Luxembourg for tax purposes is less than the income for commercial purposes, and that difference doesn't get reported anywhere, right? So let's say Luxembourg for commercial purposes made 100 in income, but it only reports 20 and gets taxed on 20, and the 18 never gets picked up in another case. But that is not the case here. FTE's financial income equaled its taxable income, so there's no missing income in terms of higher interest received or lower interest paid to related parties. This also means that the interest paid by FFT by the group companies are presumed to be deducted by the group companies and nothing more. Right? It also means that the interest paid by FFT to group companies are presumed to be taxable in full with those group companies. And, you know, with the Luxembourg corporate tax rate was 28%. And that means that the tax rate arbitrage between these countries, or the opportunity therefore, is minimal. So why was the Commission unhappy? And the Commission does say something about this in their letter of 2015, or their decision. They say, finally, in the present case, the amount of taxes paid by FFT to Luxembourg influence the pricing conditions of the intragroup loans granted by it to Fiat group companies, since they are based on a WACC and a margin, right? So for Luxembourg, for FFT, you needed to look at the weighted average cost of capital to determine what its income would be. And the lower that could be, the lower the margin could be, the less interest the debtors had to pay to FFT. But it doesn't change this. Both FF North America and FFT borrowed from the market. The interest that they paid to their lenders, whether it be via bank loans or bonds, would be at market rates. So the only saving really could be the spread on the loan to loan, borrowing from third parties and lending to group companies. Or, of course, there is the fact that, you know, FFT had a very narrow equity on which it had to calculate its taxable income. So the return on its total equity of 285 million was only a return that actually was calculated on 28 million. And that very, very narrow margin there would be the saving for the group as well. But this issue does make one wonder where the benefit for Fiat lay. Now when we look at what the Advocate General said about the rest of the case, it said, you know, it followed all the objections that Fiat and Ireland and Luxembourg had, and it shot all of them down, and especially with regard to applying the arm's length principle and correctly. The Advocate General agreed with the General Court and with the Commission. It said, I suggest that the Court of Justice should reject the first part of the first ground of the appeal in its entirety. The General Court did not make any error in the law in holding that the three errors in the calculation of the remuneration of FFT's financing and treasury activity prevented the reliable approximation of an arm's length outcome. I emphasize that FFT does not challenge the General Court's statement that the amount of FFT's resulting remuneration would still be considerably higher than that accepted by the tax ruling, given that the rate would be applied to the full amount of capital, which represents an amount 10 times greater than that to which the rate was applied pursuant to the tax ruling at issue. And the Advocate General concludes, he says, in light of all the considerations, also dealing with the other complaints of FFT and Luxembourg, I propose to the Court of Justice that it should dismiss the appeal in its entirety. But that is not what happened. The Court of Justice, inspired by Ireland and its intervention in the case, said, you know, we need to look at which rules are applicable here, because there are the OECD transfer pricing guidelines, which can be applied, but those are theoretical rules. Then there are Luxembourg tax law, the general tax law of Luxembourg, and then there are specific rules such as the ruling at issue here in a special section in Luxembourg tax law, which deals with finance companies. You know, and in order to have illegal state aid, you must treat one taxpayer better than other taxpayers, right? You must give them an advantage, and that advantage must be selective. If it is available to everyone, it doesn't matter, but if it's only available to one or to a certain group, then it's become selective, and then it can be illegal if it's not been approved by the Commission up front. And what the CJEU says, it says, you should not have looked, Commission, at the transfer pricing guidelines because that is not Luxembourg law. You should have also not have looked at general Luxembourg law. You should have looked at the specific rules applying to finance companies in Luxembourg. And there were 21 companies which had this ruling. So you can't say that Fiat was the only one that benefited from the system. Therefore, there was no selectivity, right? And the court then goes on. It says, it should be noted in the first place that without harmonization, any fixing of the methods and criteria for determining the arm's length outcome falls within the discretion of the member states. So they don't have to follow the OECD rules. They can have their own rules. The court goes on to say, it follows from the case law cited in paragraph 101 that the present judgment, such an error in determining the rules actually applicable, like the Commission did, and in identifying the normal taxation, invalidates the entirety of the reasoning relating to the selective advantage. Because again, the Commission should have looked at whether, within this group of 21 companies, maybe Fiat was treated special, or whether the group of 21 companies was treated special, right? And the court goes further and it elaborates on this. It says such a finding does not, however, rule out the possibility that the direct tax measures, such as rulings granted by member state, may be classified as state aid, provided that all the conditions of 107 has been fulfilled, right? And including the selectivity with regard to that group of taxpayers. And the court even goes on, it almost gives the Commission instructions, one feels, when it says, in particular, the Commission must be able to establish that the parameters laid down by national law are manifestly inconsistent with the objective of non-discriminatory taxation of all resident companies, whether integrated or not. There was this issue here of the FFT was integrated, which distinguished it, and it was a finance company, which distinguished it from general Luxembourg companies. And therefore it formed a special group, right? And the court said, look at that, and whether that systematically leads to an undervaluation of transfer pricing applicable to unintegrated companies, such as finance companies, as compared to non-integrated companies. So if this group is treated better than others, and there is selectivity in that, then this could be state aid for all 21 companies, right? And the court then concludes its decision. It says, on those grounds, the court, Grand Chamber, there were 15 judges, I believe, hereby joins the two cases which dealt with Fiat, sets aside the judgment of the General Court because the court was wrong, and annuls the Commission decision that there was state aid with regard to Fiat. So Luxembourg and Fiat won. The question is, what did they win? Because where does this leave us for tax purposes and transfer pricing purposes? First of all, it's important to remember that Luxembourg and Fiat won the case on grounds of EU law, right? Because this was a state aid case. To have state aid, there must be selectivity. That's what Article 107 of the Treaty on the Function of the EU says. And the Commission didn't fail at proving that the transfer pricing rules, when looking at the OECD rules, are applied wrong. They simply failed at proving that there was selectivity because Luxembourg law applied to more than just Fiat. So the Commission did not say, the Court of Justice of the EU did not say the Commission's application of the OECD arm's length principle was wrong. It said that it was the wrong criterion, as it should have used Luxembourg law. And then the CJEU did also not say that Luxembourg finance company rules as a whole do not constitute illegal state aid. It only said that Fiat did not get a selective advantage, as there were 21 companies getting the same treatment. That was a long case. It's a complicated case. I hope you enjoyed following it, and I look forward to discussing our next case with you the next time. Bye for now.